first edition of the Equity Market Insight in 2024. Good to be back here again talking about equity markets. So what we are going to do, as usual, following the template, is that I'm going to be covering some of the macro factors, the economy, and some of the other things that might impact the market in 2024. And once I've covered that along with earnings and valuations, I'll hand over to my colleague Ankit Agarwal, who's with us on this call today. He's going to be talking about the mid and small cap strategies, which are the funds that he manages. Of course, he also manages our innovation fund. And having put all of this together and helping us host this will be Niranjan, our colleague from the product team. He's also going to take any questions that you send in during the webinar. And then, right at the end, we'll have some time for Q&A. We've already received some questions, but, happy to take any questions that come in from those of you who are watching this webinar. Always helps us customize and make sure that what gets discussed on this webinar is of interest to you. So without any further ado, we'll get going. I'll request Niranjan to bring up the presentation on the screen. So this is the Market Insight Equity for Jan 2024. So what are we going to be talking about today? So I thought it would be interesting to just step back for a moment and understand the kind of money flows which came into the market in 2023 calendar, and at the same time, the kind of supply that also came in to meet the demand. The reason I'm doing this is that very often people talk about money coming into equity in a bit of a silo, in a vacuum, without reference to the fact there is also supply of stock which comes in from the other side. Now, most of you are very familiar with the numbers that come into the mutual fund industry on a monthly basis through SIP. It's published on a monthly basis by AMFI. It's carried in the press, and all of you know that money comes in, and then very often people simplistically assume that, if the money is coming in, that should cause stock prices to go up. So I thought it was useful just to look at an analysis of what happened in 2023. And of course, some of this data is much more long-term in nature, but let's look at where the issuances and the secondary sales happened in calendar 2023. So on the first slide, sorry, if you can just go back to the previous slide. Yeah. So on this slide, we've got two numbers. We've got the IPO number, and we've also got the offer for sale, both of which happen through a regulated mechanism. And you can see two numbers over there. The bars show you the total amount which was raised in US dollar billion. And on the bottom part of that chart, you can also see the number of issues that took place. So for example, in 2023, there were 57 IPOs, and they cumulatively raised about $6 billion. The recent record was, of course, 2021, where almost $16 billion was raised through about 63 IPOs. So the number of IPOs has gone back to, recent peak, of course, still well short of the previous peak of 100 in 2007, but the quantum raised much smaller. So just keep that number in mind, $6 billion of money raised by way of IPOs in 2023. On the right side, you can see the offer for sale, which is effectively a secondary sale done by somebody through the exchange mechanism. And the total amount of such sales is roughly about $2.5 billion in this year, much smaller than what we've seen in previous years. 2015, 17 were much bigger numbers, but this year was about $2.5 billion and about 20 issuances. So we move on to the next slide to look at two more sources of supply. Right, this is the supply of stock which is coming into the market either by way of new issuance. So, for example, on the right-hand side, we have QIPs, which stands for qualified institutional placements. These are placements in which only institutions can participate, and these placements raised in excess of $6 billion during 2023. The record was 2020, where more than $10 billion was raised, and this was the supply which came in that year. And you can also see that there were 45 issuances which happened through the QIP route in 2023. Finally, on the right side, as you know, in India, we have a very active venture capital and private equity market. Many companies have been funded by venture capital and private equity. And then after the company gets listed at some point of time, these venture capital and private equity investors look to sell down their stakes. So this is the stake sales which are done by the PE and venture capital funds. Also, in some cases, promoters have used this as an opportunity to reduce stakes. So what we have in this right side chart is typically secondary sales. These are secondary sales by promoters, venture capital, and private equity. And these are typically large size transactions. So small value transactions have been excluded from this. We've only looked at large value transactions in this. So it's not necessarily a comprehensive, but a reasonable estimate of the size of promoter sell downs. So going to the next slide, we can put all of this together for CY 2023. Promoters, venture capital funds, and private equity sold $20 billion worth of stock. Qualified institutional placements raised $6.5 billion of stock. Offer for sales, which is secondary, raised $2.6 billion, and IPOs raised about $6 billion. So you put all of this together and you land up with almost a number of about $35 billion of supply of stock, either through the primary route or through the secondary route coming through to the market. Now, on the other side, if you look, we've put in the number for how much stock was net purchases done by domestic institutional investors. So when you look at their this number is again reported on a daily basis. When you cumulate their net buying on a daily basis over the course of the year, it comes to about $22 billion of buying. And foreigners, though they were quite muted in the middle of the year, towards the end of the year we saw a lot more by way of flows, particularly in November and December. So at the end of the year, almost $21 billion of flows came in from foreigners as well. So if you just add these numbers, you've got about $40 billion of demand on the right-hand side, $43 billion of demand from institutional investors. And on the left-hand side, you've got about $36 billion of supply. So this is one way of thinking about, how demand and supply takes care of itself in the market. Because, a very simplistic understanding would say that $2 billion of buying every month in the market, if there is no increase in supply, then, prices would have to go up. But keep in mind that as those prices go up and as entrepreneurs find reasons to raise capital, which is being made available to them, they will supply you with stock and use that money to invest in the business. So the capital market exists for a very simple reason. There are entrepreneurs on one side, there are companies on one side. These require money because for any business to grow, it requires capital to be invested. Now, who's going to supply that capital to them? Some of it can be reinvested earnings, but the rest of the capital has to be provided by investors. And that is what you are seeing on the right side. So, $43 billion of money was provided by institutional investors to companies. Of course, we have not accounted in this for what other investors might do, which could be non-individual investors, it could be individual investors. But this is just to give you a top level feel of how capital markets function. The purpose of a capital market is to convert the savings of individuals into investments, and entrepreneurs use those investments in their business to then drive those companies to a different level. So that's the way we think about demand and supply, not merely as demand as a reason for prices to go up or supply as a reason for prices to come down. A healthy capital market is necessary for an economy to grow. And this kind of exchange between investors and entrepreneurs is key to ensuring that the economy itself continues to grow. So we'll move on from this to talk about some of the data on the economic side. So what we've got here is the Bloomberg estimates for 24 and 25. Now, one very noticeable thing about this would be that many of you would have seen the advance release for GDP for FY24, which came out last week. And that expects, that's a government statistical department estimate. They estimate GDP growth for 24 at about 7%. In comparison to this, most of the private forecasts, or rather not private, but all the professional forecasters who make their numbers available on Bloomberg still have an estimate of only about 6.6%. I do suspect this number might get dragged up slightly higher, but without doubt, there is a little bit of a gap between where the advance estimate by government is and where the professional forecaster estimate of GDP growth is. For FY25, the Bloomberg estimate is that growth slows slightly to 6.2%. Keep in mind that even when you look at the current year, which is FY24, the first half had growth of almost about 7.5%. So there is already, even in the advance estimate, a underlying assumption that growth will slow in the second half on a year-on-year basis to under 7%. That's the reason why the full year estimate is actually in the advance estimate just slightly above 7%. So a slowdown is already in the advance estimate for the second half, and we are seeing some of that in the professional forecasters estimates for 25, where GDP growth is about 6%. So that's sort of the estimate over there. I'll also talk a little bit about inflation and current account, but we'll see some detailed charts on this on the next slide. So if we move to the next slide, this is what I would want to highlight. On the left-hand side, we've got core inflation and CPI. Now, remember, RBI's target is actually the CPI number. So they are looking at 4% plus or minus 2% as the number which they want to see in inflation. The good news, I think, if you are the MPC member, is that when you look at core inflation, which is that yellow line, it was uncomfortably high in 2022 when RBI was hiking rates aggressively. You can see the rate hikes on the right-hand side, starting from early 22, the hikes that they did. But ever since then, there's been a gentle decline in core CPI. The latest print was closer to 4.1. Now, of course, in recent days, the RBI governor in particular increasingly talks about 4% as target rather than talking about 4 plus or minus 2% as the target. So in a sense, the core inflation coming down to 4.1% does give you some comfort, but there is still some heavy lifting which needs to be done here because headline inflation is still at about 5.6. And remember, the RBI target is headline, not core. On the right side, you can see RBI's hard work on the repo side. Of course, they never hiked as dramatically as the Fed did, but then the Fed was starting also from a much lower point, almost the zero bound. So the Fed is now up to 5.5%. The gap in policy rates is about 100%. The market is now starting to expect significant rate cuts from the US Federal Reserve in 2024. The same is also being expected in India, but in India, I would say the expectations are more muted, and we'll talk about why they are muted when we get to the summary slide. I also said we'll talk about current account deficit. You can see this on the next slide. Remember, 2022, particularly after the Russia-Ukraine conflict broke out, was a point of concern for the current account deficit, right? So on a trailing basis, it went as high as 4% of GDP. It most probably finished the year just under 2% of GDP. But looking at the current trends, we look to be running at about 1.6 to 1.7% of GDP. That is well within the comfort zone of the RBI. So I would say from a current account deficit point of view, things look comfortable. The only worry, if at all, might be that FDI, when we look at net FDI, is very, very weak in the current year. It's partly got to do with one of the slides you saw earlier, which is that PE and venture capital funds have removed in excess of $12 billion of their earlier investments. So when you look at net FDI, in general, gross FDI itself is lower, and net FDI is even lower simply because they've taken money out rather than put large monies to work in India. However, what is making a difference is on the right-hand side. Even though the you can see the goods deficit in the green bar, but what is really making a difference to helping India balance the current account and the trade balance in particular is the remarkable growth which is happening on the services side. So you look at the March 20 number for service exports, services surplus rather, and look how dramatically that number has improved. Once you get to March 24, that's of course an estimate number. It almost doubles during this period in terms of the net surplus. So this is giving us a lot more comfort in terms of the current account, though, as I said earlier, net FDI is a going to be weak this year, and that is a little bit of a cause of concern, but arguably something that RBI can manage. So we'll jump on from this quickly. I won't look at this. This is more the headline numbers of the short-term trajectory that we are seeing for high-frequency indicators. Nothing particularly notable here, but we can move on to the section on earnings and valuation. Okay, we've also got one slide on performance. I'll actually jump to the next slide, which puts India's performance in the context of global markets. Going into 2023, there were a lot of concerns, US recession, etc. None of that actually happened. The US finished with a 14% return. But remember, the US NASDAQ actually finished with a 55% return, which is a mind-boggling number considering the size and the total market cap of the NASDAQ. Some of the other markets as well, both emerging and developed markets, did very well. Germany plus 20, Brazil plus 22, Japan plus 28, Mexico and Korea pretty close to India. And in fact, the Mexican currency saw a very sharp rally. So in dollar terms, its gains were actually quite significant. But in general, you can see, that India had a fairly good year for itself. But this was, in retrospect, a fairly good year for many markets, including emerging and developed economies. Only two markets had a really horrible time, and that's China and Hong Kong. We've talked about this in the past, and I think that will continue to be a little bit of an issue, even though those markets have derated quite significantly over the course of the last 2 years. Moving on to the earnings picture. For March 24, the earnings estimate is about a 15% growth. For March 25, it's about 14% earnings growth. I will ignore the March 26 number. We've included it here because analysts are publishing it, but I'd say it's a very low visibility number at this point of time. But 14%, March 24 is now only 2 months away. So you could look at March 25 now as the anchor. So it looks to be about a 14% year is the current estimate for March 25, which is, much better than what we have seen pre-2021, but obviously the period of March 2021, or rather we can go back to March 20. March 20 to March 23 is a remarkable period for Indian corporate earnings. You can look at that. In March 20, earnings were 489. It jumped to 835 in the period of just 3 years. Almost like a 70% increase in a 3-year period. But if you look at the previous period prior to that, earnings growth was more or less single digit. In comparison to that single digit, a 14% outcome in March 25 is better. But in comparison to the last 4 years, it would amount to a little bit of a slowdown. What about the trend in forward forecast? You can see that on the next slide. On the absolute left-hand side is March 24 numbers. There has been some decline in March 24 estimates. But when I look at previous years, from the start of the year to the end of the year, the cuts have been quite dramatic. I would say for March 24, right now the cut looks like under 3%. That's actually a pretty marginal cut compared to what we've seen in the past, where the cuts are more dramatic. For March 25, there have been quite significant cuts from March 23 to today. So almost like a 5% cut, which has happened over there to forward estimates. And I think increasingly these numbers will get in a very, very tight range once we get to March 24. Again, March 26, too early to discuss. We'll just sort of leave it for the time being. Moving on from that to valuations. Nothing new here on the PE. These charts don't look too different from what you saw last time, except that, the lines have moved up because the markets were up sharply in December. So that's pulled all the valuations up. But on the next chart, we've got the price to book of the Nifty 50. This is above the long-term average, but still somewhere within the fair value zone. So when you look at the forward PE multiple, it's in the expensive zone, but the trailing price to book still very much in sort of comfortable territory, higher than average. Trailing PE multiple also higher than average, but not outside the comfort zone. And that's one of the numbers that feeds into our asset allocation model, which is now modeling for asset allocation at about 50%, which I would say is in the neutral zone. If our asset allocation model, which powers our multi-asset strategy and the balanced advantage strategy. If you look at the range in which they can have an equity allocation, this 50% position is sort of indicating a more neutral position rather than an aggressive position, bearish or bullish. So it's more neutral. The next chart is more concerning. Chart is more Nifty mid cap and the Nifty small cap. Yeah, so on the left hand side is the Nifty mid cap, right side Nifty small cap. We've seen the Nifty mid cap trade at a premium to the Nifty in terms of price to book. Unusual for the small cap to do it, but that is exactly what has happened. And I would say there's not much for me to add here. Both these firmly in expensive territory, and therefore from a valuation point of view, we worry more about risk today than we worry about return. So that's the way we think about mid caps and small caps. Relative comfort is more with the large caps at the current point of time. Moving on to the next few slides. So this is another factor which feeds into our asset allocation model, the comparison of the earnings yield of the Nifty to the 10-year GSEC. This is currently at a very unfavorable location because it's pretty much gone to sort of record levels where equities are unfavorable and bonds are more favorable. And again, this is one of the factors that feed into our asset allocation model. We can just jump now. We've already talked about mid-cap. Yeah, so we'll just go to the takeaway slide. I've talked about this last month. US economic data extremely robust. Good news, inflation is trending lower. The market is already discounting that there will be 140 basis points of rate cut in calendar 2024. This is a slightly high bar in our opinion because, remember, US inflation is still running well above target. Will they be able to deliver 140 basis point of rate cut? Slightly uncertain. The only reason they may do that may actually not be a very good reason, which is that the economy slows more than anticipated. Maybe that recession actually happens sometime in 2024. But I would say it's a high bar right now to get 140 basis points. Having said that, the long-term bond yields in the US, we think, will be more sticky. One reason for that is the fiscal deficits in the US are now running much higher. Unlike in India, where we are now talking about a reduction in fiscal deficit over the next few years to get back to the levels that we were in pre-pandemic, US is talking about running the fiscal deficit lower than the peak pandemic fiscal deficit, but at much elevated levels compared to pre-pandemic, which means a lot more issuance happening by the government. Simultaneously, the Fed is also trying to sell bonds because it is now embarking on what is colloquially called quantitative tightening, which means it is selling the bonds on its books. Now, when you have the Treasury issuing new bonds and you have the Fed trying to sell bonds, it makes it slightly difficult for long-term yields, in our opinion, to come down aggressively. In India, November CPI, we already discussed this, 5.55%. It's within the target range, but we think the rate cuts are back-ended because the focus is now on inflation at 4% rather than just 4 plus or minus 2. We talked about the earnings growth estimates. We also talked about the dichotomy in valuations. So what should investors do? Our preference would be a staggered approach towards equity. We prefer the large cap space and strategies that run larger which have a bias towards large cap allocations are to be preferred. We've talked about the UTI focused equity fund and the UTI large cap fund in that context. And finally, if you want to invest lump sum, then consider strategies that have a more hands-on approach based on valuation models or otherwise towards equity allocation. These are funds such as the Balanced Advantage and the Multi-Asset Fund, and also the Equity Savings Fund. These are where you could consider lump sum investments. So I'll pause at this point. This is sort of a wrap of the macro backdrop and also our views on markets and where to invest that I wanted to share. So I'll halt here and hand over to my colleague Ankit, who will talk in more detail about his investment strategy for mid and small cap and how he thinks the market is currently positioned. Over to you, Ankit.
Thanks a lot, Vetri. Thanks a lot, everyone, to come for this market insight session. So I would be, broadly covering the strategy that we follow in the mid cap and the small cap fund. Yeah. So I think just to sort of take a step back and understand why should we invest in the mid and small cap space? I think one of the reasons why we sort of also came up with the small cap NFO was the exposure to some of these emerging sectors is very high in the small and mid cap space, and therefore purely from either sectoral diversification perspective, where typically if you see the large cap indices are more skewed towards sectors like IT, oil and gas, FMCG, financials. If you look at the mid and small cap space, there the diversification of sectors is much higher, and a lot of new sectors. If you see over the last few years, we have seen a significant activity on the IPO side, and therefore you are seeing many companies with newer business models coming into public markets. I think if one were to sort of benefit from the growth in some of these sectors, you have to be in the mid and small cap space. So the mid and small cap does provide you sectoral diversification and also ability to invest in sectors, a diverse set of opportunities. Yeah. I think one of the key reasons why UTI is very well placed, because we have a fairly large coverage of companies, and typically we have seen that in small cap space you have very thin analyst coverage, and therefore you need to have a very strong institutional framework of identifying companies and also filtering out companies which could be wealth destroyers in future. So I think as a manager for the mid cap and small cap funds, I think one of the bigger challenge for us is what to not own in the fund, because markets goes through cycles, and therefore last 1 or 2 years have been place where markets have given good returns in mid and small cap space, and therefore people's focus on risk has come down significantly. But these are the times when you can end up making big mistakes in your portfolio, and therefore you have to be very, very cautious about what you own in the portfolio, so that when the cycle turns and or when you see some volatility in the markets, your portfolio can really hold on during those periods of volatility. So I think having an institutional framework to filter out companies is very important, and that's where UTI, with a very large team of analysts and a fairly large coverage of companies, stands quite comfortably from a research process perspective. I think the broad strategy, the investment approach in both and mid and small cap, both strategies, is to have a higher allocation to companies which we call, which have very high scalability. And what we mean is that these companies have either a consistent track record of growth, they have sustainable business models, and they are operating in sectors which have a very long runway of growth, right? These companies are typically run by seasoned management, and they are very high quality businesses, which could be demonstrated in terms of either they have a very high profitable volume growth, significant, either they are they're lowest cost producer in certain product, or they have some amount of product innovation, which finally all of it gets reflected in generation of high returns on invested capital. So a large part of my portfolio, almost 60 to 70% of the portfolio, would be focused towards such scalable business models, which will give you a strong core to the portfolio, and therefore you will see compounding growth in that part of the portfolio. But what we also want to do in the rest 30-40% of the portfolio, to have either a turnaround strategy where you are buying businesses which are high quality, or companies which are maybe possibly leaders in the space that they operate in, but are going through maybe a temporary downturn, or maybe the macro is not in their favor. And therefore, if you buy these businesses when the cycle is not there in their favor, when the cycle reverts, you see a disproportionate return in your portfolio. You also want to invest in transformational change businesses, which are maybe going through certain underlying transformation, which can be a trigger for a possible re-rating. So we basically want to create a balanced portfolio between growth and value opportunities, which can give you certain amount of consistency and performance across a cycle. So that's the focus of running the mid and small cap strategy. Next slide. Yeah. So I think this sort of broadly sort of summarizes the focus that we have when we trying to filter stocks in our portfolio. So one, we are trying to find what we call large cap isotopes in the portfolio. These are companies which are market leaders in the space that they operate in, which basically means that these companies are typically akin to large caps in terms of their leadership, the balance sheet, the way they have maintained it, the capital allocation that we have seen in these companies over a period of time. And, they are operating in possibly, niche sectors, and, they have fairly high growth potential. So, you're looking at companies which are market leaders. Then secondly, you want to also invest in companies which have high levels of governance. And this basically gets lost in a fairly high where the risk in the market has significantly sort of reduced, and perception of risk has obviously come down. But we believe that in times of stress, typically you need to back managements with good governance track record. And third is on risk mitigation. So you basically focus on protecting downsides in your portfolio. So typically, if you see historically, we have seen the segment being fairly volatile, and therefore our learning is that if you are able to protect downsides in your portfolio by focusing on high quality businesses, then across a cycle your portfolios end up doing well. And therefore, whenever you look at the performance of the portfolios, you should judge them across a cycle, because when the perception of risk in the market has come down, when you are seeing a very sort of a broad-based risk-driven rally in the market, at that point in time, some of the softer aspects take a back seat. But our sense is that this space goes through its own phases of volatility. We have seen that play out in different cycles in the past, and therefore one needs to be a bit cautious when you're looking at especially the small cap space, because there in times of when there is market-wide sort of optimism, some of these softer factors, they take sort of a back seat. So our focus continues to remain on risk mitigation in this portfolio, where you sort of have a larger allocation to high quality businesses, focus on high R1 businesses. Also, have style diversification and try to reduce sort of more idiosyncratic risk. Basically, do not want, so we manage these portfolios with a very diversified holding, so that you don't take risk with respect to one specific stock, or you try to sort of mitigate impact of any subsectors also underperforming. So think of it in a way that these portfolios are designed to do well during downturns, and if in an upturn they are even able to participate in an upturn across a cycle, these portfolios will end up doing really well. So the portfolio is designed for sort of long-term compounding, and to see that happen without taking significant risks in the portfolio. What are large cap isotopes? Just to give you a sense, these are companies which will operate either with have a large dominant market share in a niche sector that they operate in, or they'll enjoy significant pricing power, where either they are having a brand, and therefore so their ability to pass on commodity prices is much stronger. Or these companies could be in probably manufacturing space, where they get significant advantage of economies of scale. They may be largest producer of a particular niche product, etc., in the global market, and that gives them the ability to be the lowest cost producer, and that becomes their sort of a moat for them going ahead. These companies typically will have well-managed balance sheet. Their track record of capital allocation is very good, and they have easy access to capital like their larger cap peers. We have also seen that some of these companies, the reason why they tend to do well during downturns is that in periods of downturn, typically the stronger players, they tend to gain market share from weaker unorganized peers, and therefore they end up gaining market share during periods of downturn, and are able to consolidate that when the upturn happens. And lastly, you're talking about companies with a strong track record of governance. They may be professionally managed. They have a strong execution track record. So management quality, again, is pretty strong in these businesses. Yeah. I think the other way of managing risk in the portfolio is also to, one, we talked about risk mitigation, but also to, make sure that we are managing the portfolio with a diversified holding, because the whole idea here is that investors can come in, go out. Small cap, specifically the small cap space, is one where you would see significant impact cost for going in and coming out of a stock. And therefore, you should not be in a position where you take significant exposure to one company. And if something goes wrong over there, the impact cost in the portfolio is very high. So we maintain it by having different sector and stock limits in the mid and small cap space, where you restrict the amount of active weight that you can take in the portfolio. Yeah. Next. Again, just to sort of very broadly, when we look at large cap isotopes, you're talking about market leaders, and therefore you can see that in different holdings that we have in the fund, where companies are either market leaders in defense equipment, or the anti-infective space, or the cables and wires, or mall development, CV financing, CPVC, pipe segment, etc. So we are betting on the companies which are _1 players in that particular niche sector. And as that sector sort of continues to grow going ahead, you will see these companies disproportionately grow and benefit from the growth in that underlying sector. I think one of the key things that you should also understand, and this is how we manage funds across different strategies within UTI, is that we want to maintain our style discipline across cycles, right? So you will see that the way we manage our portfolios, you'll see them across cycles, if you see. And the way to understand that is through looking at the proportion of, say, R1, R2, R3 companies in our portfolio. So for example, our orientation in the mid and small cap space is slightly on the higher R1 side, and therefore you will see that the R1 proportion across the different cycles, and we've been managing this now for 3 years, is basically, if you see, is fairly consistent. So you will see that around 60% is where we keep the R1 proportion. R1 companies are basically companies which have pre-tax ROC of 18% plus, and therefore they are typically more consistent, less cyclical businesses, since we are looking at a more sort of long-term ROC in this case. So I think that's how we manage these portfolios, and that's how we will be looking at managing the portfolio in the strategy. Yeah. On the small cap fund, I think these are some of the holdings in the fund. I think the approach here is very bottom up in nature, but the idea here is look at, again, market leaders in the space that they operate in, and hopefully as some of these niche sectors become big in future, your investments in them will also see that compounding benefit. Yeah. Again, here, if you see over the last 3 years, now we have some sort of a 3-year track record here. If you see the proportion of R1 companies continue to remain fairly high, and that's how we have managed this fund across different cycles. So I think this is a characteristics that you will see across strategies within UTI, where the style bias is maintained fairly well, and that's how we want to maintain our strategies even going ahead. Yeah. Sure. I mean, that's it from my side. I think I'll pass it on to Niranjan to take forward the Q&A.
Yes, sure. Thanks a lot, Ankit, for a detailed rundown on our mid and small cap strategies. So we will now move on to take the questions which are coming our way for the next 15-20 minutes. So, Ankit, this is the question to you coming from our investor, BK Goyal. So, the mid and small cap segments have surprised the markets with exceptional performance in the calendar year 2023, right? So, however, the return divergence within the performing pack is also quite high, right? So, how do you view this return divergence within the mid and small cap segments that we have seen, and also which are the pockets of opportunity you see going forward?
Yeah. No, I think it's a fair point that we have seen return divergence within different styles within same within different sectors, and we have seen return divergence between similar stocks in same sectors also. So for example, we have seen in while maybe the larger banks may not have performed as well, some of the mid-sized banks, etc., have done really well. From the IT side, while large IT hasn't done that well, probably the mid and small IT have done well. So I think we have seen significant return divergence between the two, within the sector, and we have also seen that within sectors where the companies which are more sectors which are more value focused have done much better, and the traditionally more consistent quality focused companies have relatively underperformed. And I think some of it is also to do with the fact that we are seeing an underlying slowdown in consumption, so therefore a lot of your high quality consumer companies have seen certain slowdown. Where we are seeing a good amount of work happening is where government is pushing sort of either a capacity creation in the country. So they are sort of incentivizing sectors and companies to set up capacities for import substitution, or to sort of do a lot more assembly work in India. Or it is in the form of infrastructure, whether it could be defense, railways, etc., where government is significantly putting capex, I think so. And typically some of these sectors are more focusing on the core, and therefore those have done much better. But historically what we have seen is that style also goes through its own cycle. So there are periods when like how we have seen large cap, mid cap also going through cycles, where there are periods where large caps significantly outperform, mid caps underperform. There are also periods where value outperforms and quality underperforms, and vice versa. And therefore our portfolios there, so when you think about portfolio construction, you have to think about all whether not only from market cap segmentation perspective, but also through style segmentation perspective. I think that is something which has become quite that people are getting more understanding about, that you need to have portfolios or strategies which have a different style bent. So therefore, if a certain style does well in a certain market, you do end up benefiting from that. So the way we manage the mid and small cap, and like I've highlighted, that we manage it with a more quality bias. And we have not seen quality do that well in the last 1.5 years. But our sense is that going ahead, some amount of this mean reversion will play out, where now there were long periods when quality did well. I think post the COVID, you have seen significant outperformance in value. I think that cycle will somewhere also revert, and once you see quality start performing, more quality driven portfolios will end up doing much better. So that's how I would look at it going ahead.
Sure. Thanks, Ankit. In fact, there is a follow-up question on the similar lines, right? So, while you did mention that the value strategy has actually done relatively better in the last 2 to 3 years. So, how is UTI mid cap and small cap fund is positioned today to sail through this changing season? And also, what sort of portfolio changes you have envisaged or looking forward in the fund, if you can throw some light on that?
Yeah. No, I think, the way, what we had highlighted in our presentation in some of the slides is that, the idea is to maintain, so the style bias or the style purity is maintained across cycles, right? So, if, and, this is across the strategies that we maintain within UTI. is that, if a certain strategy is, focusing more on the quality growth bucket, it maintains it through cycles. If there is a certain strategy which does, which is focusing on value, they've continued to focus on value across cycles. And therefore, you would see within the UTI umbrella, certain strategies doing well in certain periods of time, and maybe some of them may be taking a back seat in, some of the others. But the fact is that, across a cycle, when you look at it from a longer term perspective, both these strategies, they tend to sort of converge. So our focus is that, we will not change our portfolio allocation basis what's, what style is doing well in that particular season. But your strategy should be able to do well when that, that particular season is playing out. And therefore, over a long period of time, as you see these strategies converge, your portfolio performance will then converge more, or will drive alpha more from your stock selection rather than what style you are biased towards. So I think that's how we focus on different strategies within UTI. And I think we'll stick to that particular, focus. I think the way investors and advisors can sort of deal with that in their individual portfolios is to maintain certain style diversity within their own portfolio allocation. I think that's how you would be able to mitigate or manage this sort of seasons of, quality playing out, whether it's value or growth. Niranjan, you're on mute.
Yeah, sorry. So before I take the question to Vetri, so in fact, there are more questions coming on mid-cap. So I'll take one more question to you. So audience are actually asking, if you can throw some, examples on large cap isotopes. So if you can just elaborate on that piece with a couple of examples.
Yeah, so I mean, I don't know, Niranjan, can you just share that particular slide that we have?
Yeah.
So large cap isotopes, see, the whole idea of isotopes is basically coming from chemistry, where we are saying that the two, the two elements have same chemical properties but different physical properties, right? And therefore they, they sort of have same characteristics, but they are different masses. And that's what we are trying to do in mid and small cap space, that we want to buy companies which look like large caps, or maybe which are large caps in their sector that they operate in, so they might have market dominant position in a small sector, like, so for example, something like, say a Bharat Forge, right? It's a leader in the auto component forging space, whether it's maybe Bharat Electronics, right, which is market leader in the defense equipment, or it could be an Astral, which is a market leader in the CPVC pipe segments, or a Shriram Finance, which is probably market leader in the CV financing space. So, you have a lot of these companies which are actually dominant player in that particular segment that they operate in. And therefore they are, able to exhibit similar characteristic of a large cap. They have well-managed balance sheets, good management. They perform much stronger during downturns, because in a downturn, typically market leader ends up taking much higher share from the weaker players. And when the cycle reverts, they typically end up, consolidating that share at a higher growth. So, those are the companies which give you much lesser volatility, and over a period of time, you'll see that more consistency playing out in your portfolio. So the idea is to build a portfolio around that, so that in the long term, you get more consistency. And especially in a time like this, where we are seeing, markets at a fairly high or reasonably expensive level, I think the focus towards quality has to go up, because you do not want to, be holding companies which you are not having comfort to hold for the next 5-10 years, right? So I think at this time, one should have a little bit more quality orientation and bet on these companies which are market leaders. So think of it like large caps in a mid cap sector, right? These are essentially those companies in the mid size space.
Sure, Ankit. Thanks for that. Yeah, so Vetri, this is a question to you. So Primarily, the Indian economy grew at 6.5% in the year 2023, so outpacing most major and even emerging economies, right? So, however, how do you view the monetary policy in India for the current calendar year, at least for the next couple of quarters? And what are the likely impact of the monetary action on equity markets?
Sure. So, Niranjan, obviously the Indian economy, and this is both the RBI estimate as well as government estimate, FY24 will be close to 7%. Now, we don't know what is the growth potential, but I would say, RBI's own past comments suggest that they think 6.5% odd is sort of the potential level of growth. So, from their point of view, growth is at full potential. Inflation is actually still above the target, particularly when you interpret the target as 4% inflation. So to our mind, there is no pressure on the RBI to cut rates. At least if growth was slowing, you could make a case that, at which point do we look at the real rate and say the real rate is too high. But, today you've got the policy rate at 6.5%, you've got headline CPI at 5.5%. So, you can't even argue that the real rate is much higher than it needs be at this point of time. So we think rate cuts, if anything, will first be more likely once the global trajectory of rates also is clearly headed lower. And in India's case, if inflation does dip below the 5% mark in the second half of calendar 24, that's when you could see RBI MPC deliver on some rate cuts.
Sure. Thanks, Vetri. The next question to you is the elections are around the corner, right? So, and in fact, the market's optimism is also centered around the smoothness and the decisiveness, that outcome of the election that we are going to see, right? So, what are the factors that are potential for turnaround in the economic sentiments or investment pattern, if you can throw some light?
Sure. So, first of all, politics, I would say the market may have been slightly unsure about what to expect in 2024, but to the extent we got a verdict in 4 states, at the end of November, it actually gave the market a sense of continuity, that there is nothing to worry about in terms of an upset. Even whatever little data we have suggests that it's most likely continuity. You can never rule out anything in politics, but I think the market is now taking great comfort in the sense that this government is certainly in a pole position for re-election. And secondly, therefore, from a market point of view, there is likely to be continuity in economic policy. So I think, that's sort of the baseline which is built in. As they say in politics, you can never predict, simply because you can never predict the mind of the voter. But, I think the base case is now well baked in. So seems little bit of a I don't think I see any cause for concern from a political point of view at this point of time headed into the election. There was talk earlier that there could be volatility. That would have been more likely if the results of the November election had gone the other way. But given the outcome that we saw in November, I think market is a lot more sanguine and it's betting on continuity. If there is a rude surprise, of course, the market will react.
All right. Yeah. Thanks, Vetri, for that. So, participants, in the interest of time, we will take the last 2 or 3 questions. Ankit, this is a question to you. So, this is a question on the sectoral level. So, capital goods. So, in fact, the portfolio of the mid cap has a major weight in capital goods with marginal overweight position, right? So, I think 16% allocation there with 3% overweight. So, however, the demand growth outlook in the sector and also the recovery which is expected in the private capex is actually not playing out as expected, right? So, what are the key drivers you expect to play out in the sector in the near to medium term?
Yeah. No, I think that's a fair point that while we are so the thing about the capital goods, the classification is that some of the companies which are more building material oriented also get classified under capital goods. Some of the companies which are even on the auto side, which are benefiting from probably the revival in CV cycle, etc., also get classified under capital goods. But if I look at the capital goods classification, which is more focused towards sort of broader private capex led companies, I think that's where we do not have a significant high weight. One, because the valuations in that space have become quite expensive, and B, our sense is that probably there could be some slowdown on the private capex side. I think what we have seen very clearly happen is that some of the segments, sub-segments are seeing a decent amount of order flow happening. So like I talked about defense, we are seeing a reasonable amount of order flow, and there is a lot of focus on indigenization. There are companies, which are talking a little bit more about, long-term export opportunity from India, and therefore, setting up manufacturing units in India which can export then out. We are definitely seeing some sort of a benefit from the whole, focus on Jal Nal. Real estate activity is also picking up, and therefore, companies which are focused either on, structural pipes, or companies which are focusing on water transportation, etc., or plastic pipes, etc. We have seen some benefit of growth in those segments. So I think when we are looking at capital goods space, I think from a broader private capex theme, maybe we are not that gung-ho, but there are specific sub-segments where we are seeing continued activity and order flow happening. And that's where, some of the opportunities in the portfolio are aligned. So I think look at it from that perspective. I don't think, from a valuation perspective, clearly the private capex led cap good names are probably on the more expensive side.
Sure. Thanks, Ankit. Patrick, this is a question to you, which is on the oil prices. The oil prices are falling on the signs of weakening demand in advanced economies and China, right? So while this is a good news from India's economic growth perspective, so how is it likely to play out if the geopolitical tension is expected to worsen and also disrupting the supply?
I think the geopolitics is obviously a risk, so you can't wish it away. You have to, have some low probability outcome that oil prices spike if the geopolitical tensions currently in the Middle East were to spike higher. So you can't protect yourself, you just sort of navigate through it. But I would say really the surprise of 2023 has been the fall in oil prices. I won't point so much to demand, but I'll actually point to supply, because I think two things happened. One is, even though Russia and the rest, more Saudi Arabia and the rest of them talked of a cut in supply in the early part of the year, the surprise has actually been the extent to which the US actually ramped up production predominantly of shale. And I think some oil has also started to flow in into global markets from South America, from some of the countries which were not pumping in oil earlier. So net, it was actually this supply surprise from the US and others which eventually caused oil prices to turn down. So I think the market remains reasonably well supplied. Don't see any reason for any huge volatility in oil prices at this point of time. And from India's point of view, $70 crude oil price is well within the realm of what the economy can navigate. In fact, I would say anywhere between $60 to $90 we are comfortable. It's only when it goes above $90 it becomes uncomfortable. Equally, going below $60 becomes uncomfortable for a different reason, because it has perhaps a indicator of falling global growth outcomes, and that's why it would have a negative indicator. But in the 60 to 90 band, I would not lose too much sleep over it.
Sure. Thanks, Vetri, for that insight. So Ankit, one question to you. So while you follow a pure bottom-up approach to pick stocks, so what are the risk control framework that you adopt under the fund in terms of avoiding the value traps or some of the wealth destroyers? And also for the benefit of the investors, so what do you recommend at this point in time, whether the lump sum investment is recommended in mid and small cap strategy, or what other approach they can actually follow at this point in time?
Yeah. No, I think, I've, like how we highlighted in our presentation also, I think risk mitigation is a very important part, when we think about investing in the mid and small cap space. And, that was our pitch even when we had, come out with the NFO. And the whole reason is that, while the return potential in the small cap space is high, during periods of drawdowns, you see a significant, volatility also in this space. And therefore, return outcomes are much more sort of widely distributed when we look at the small cap space. And therefore, avoiding some of these possible wealth destroyers, etc., in your portfolio becomes a very key, or becomes a key challenge to sort of navigate. So our focus continues to remain, in looking at, and that's where, having a strong research team, looking at ideas, etc., having a strong research coverage, etc., becomes very important to mitigate some of these risks, right? So one, from a more fundamental perspective, analyzing businesses, analyzing management, etc., the research framework enables you to reduce some of those risks in the portfolio. Second, from the portfolio construction perspective itself, we manage it like I have, had highlighted. We manage it with a much more diversified sort of portfolio, and therefore risk of any single stock, etc., impacting a portfolio significantly reduces. Third, we focus a lot more on high quality companies, and therefore, if you look at our R1 portion, is on the higher side, as and therefore the whole idea is that when you see periods of drawdowns, you typically the high quality R1 companies, they tend to outperform. And then we have certain risk risk metrics where we limit the amount of active weights, etc., or the portfolio weight that we can have in individual stocks, etc. So I think it's a combination of all these factors which enable us to sort of hopefully avoid some of the wealth destroyers and to be able to benefit from the compounding of good, well-managed companies. So I think that's how we look at risk, and I think it is an important part of how we look at the small cap space specifically, and therefore our focus is a lot more on risk mitigation. And my experience historically has been that if you can do well during periods of drawdowns across a cycle, your portfolio will end up doing much better. So that clearly remains our focus going ahead.
Yeah, thanks, Ankit. Lump sum versus SIP, if you can just...
Yeah, so I think clearly because valuations today are not in a very comfortable zone, I think this continues to remain a more SIP market in the mid and small cap space.
All right, fair enough. Thanks, Ankit. And one last question to you, Vetri, and perhaps you can conclude the session after this. So there is a collective expectation for foreign investors to re-enter the Indian equity market with renewed vigor, right? So has this been discounted in the valuation today, and which are the pockets that are likely to attract the fund flows? So if you can throw some light there.
Yeah, 2-3 points to make, Niranjan. We already showed in the previous slide, the amount of money which has come in from foreign investors over the course of the year at 23 billion. I would say it's a reasonably, handsome number. So there's no reason for anybody to feel, disappointed by that. If we want a sustainable economy which grows over time, we don't want a bubble economy, then I think it is good if the money comes in on a consistent basis rather than spike up and then spike down. So, I think we are getting a reasonable amount of money. Final point to make is that, eventually valuations are a function of what the company does and what the company delivers. So you can think of it as a combination of the fundamentals of the company, the return that the company is able to generate over the cost of capital, and the tenure for which is able to do this looking well into the future. That is what determines valuations. Valuations are not a function of will foreigners invest more money or less money. That will only create volatility in valuations. But that is not the basis on which you understand, is the company or is the market I'm buying at a reasonable value relative to the kind of returns it can generate for me. So I would not look at fund flows as the harbinger of valuations. Of course, it is pro-cyclical. Valuations tend to move higher with flows and lower with outflows. But that doesn't mean that you should be using that as the basis to invest. You should be looking at valuations as a function of being a business owner, and therefore what you are willing to pay for the cash flows that the company will generate for you as an owner, rather than the cash flows which may or may not come into the market, which anyway it is almost bordering on impossible to predict, and therefore that is not the basis on which I would go about a valuation exercise. So that's about it from my side, Niranjan. Thank you for hosting this call and putting the questions together from the viewers. Thanks to Ankit for taking us through the mid and small cap deck. And thank you for all of you who've joined us on this first equity Equity Market Insight Call webinar of 2024. We look forward to doing more of these through the course of the year. We, of course, do this every month, and once in a while we have Ajay hosting it, who, of course, does it in Hindi. If we can find other team members who can speak other languages, we'll be delighted to host it in other languages as well. But right now, English and Hindi is what we are best and most competently placed to do. So we'll certainly do those two. Thank you so much for joining us, and have a great evening.
Thanks, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.